Hey, how are you all? It's day 15 in the virtual world of this class. Um, we are talking today about the foreign exchange market, right? So we are kind of moving here in the last section of the class, the last 3 days of class. We want to talk about international issues related to to financial markets. And so today we're going to talk about the foreign exchange market. Tomorrow we're going to talk about, or on day 16, we're going to talk about the international financial system. And then on day 17, we're going to talk about the Chinese financial system, right? So we're going to kind of broaden our perspective, make it a little bit more international, talk about a lot of issues related to international finance that we haven't really talked about to this point in the class. So the foreign exchange market, that's the main topic of conversation today. So let's talk about the foreign exchange market. The foreign exchange market, or I'll often refer to it as the FX market, is the largest financial market in the world, right? Now, unlike the New York Stock Exchange, the FX market has no physical location. It's just an over-the-counter market, meaning it's just a network of brokers and dealers, many of them associated with big banks. So all the big banks have a foreign exchange desk in which they make trades for their customers or for their business that they're involved in. These are big markets. The minimum transaction in these foreign exchange markets is usually $1 million, right? And over $1 trillion a day are traded electronically in these markets. So they are very, very big, very, very competitive, with prices changing instantaneously, right? So it's a very, very competitive market. Now, in these markets, prices are determined. The prices we refer to as an exchange rate, and specifically, it's a nominal exchange rate, right? A nominal exchange rate, meaning it's the price of one currency denoted in another currency. So, for instance, if you're talking about the dollar exchange rate, what we're talking about is the number of yen you get per dollar, right? The number of yen you get per dollar. So the value of the dollar would be, today, be about 105 yen, okay? Number of yen you get per dollar. What if you're interested in knowing the value of the yen? Well, the value of the yen is just 1 over the value of the dollar, right? So the value of the yen would be the number of dollars you get per yen, which is just the inverse of the value of the dollar. So if you look in the newspaper or online for exchange rate data, you'll notice that they usually only give you one. Usually, if it's a US source, they'll give you the value of the dollar, assuming that you know enough to take the inverse of that if you want the value of the yen. And of course, the fact that the value of the dollar and the value of the yen, or the value of the dollar and the value of the euro, are inversely related, means that an appreciation of one leads to a depreciation of another, right? So if one goes up in value, the other one has to go down in value because they're inverses of each other. The foreign exchange markets are huge, but really they're very well described by just a simple supply and demand analysis, right? Where instead of a price, we have an exchange rate, right? So here, let's think about the euro dollar exchange rate, right? So here's the price of the dollar, and here we're going to denote it in terms of euros. Here's the quantity of dollars. There's a downward sloping demand for dollars, denoting the fact that when the price of a dollar goes up, meaning the exchange rate of a dollar goes up, the demand for that dollar will go down. So we have a typical downward sloping demand for dollars, and then we have a supply of dollars. And here, let's assume that the supply is vertical. Why? Because the supply of dollars is really set by the Federal Reserve, right? The Federal Reserve can determine the amount of dollars at any point in time in these foreign exchange markets. So we're just going to assume that this is set by the Fed, whatever they want. And so the supply is vertical, demand is downward sloping, and then this is a perfectly competitive market. So what will be the equilibrium exchange rate? It's just going to be the exchange rate at which the supply of dollars equals the demand for dollars, right? In foreign exchange markets, there's usually two types of transactions that take place. Just so you know a little bit of lingo here, a spot transaction, refers to an immediate trade of currency, right? The banks immediately trade currency. So if it was a spot transaction between two banks, one bank would, let's say it's in the dollar euro trade, one bank would immediately take their euro accounts and transfer it to the other bank, and the bank that's selling dollars would take their dollar accounts and transfer it to the other bank, and it would happen at that moment that the trade takes place. A forward transaction is basically looking forward, right, and making this trade at some future specified date, right? So this would be an option contract. So oftentimes forward contracts are very often used in foreign exchange markets because they're associated with, let's say, for instance, a financial transaction that you know is going to take place in the future, or an international trade that you know is going to take place in the future. So, you know, if I'm buying British goods on October 1st, one of the things I might want to do is engage in a forward transaction that locks me into an exchange rate by which I can buy pounds on October 1st and complete that transaction, right? And then that way I can limit my risk, right? The risk that the exchange rate would change. One of the things that is really important to clear up here right at the beginning is a strong dollar a good thing for the US, right? A lot of people talk about exchange rates like, you know, kind of like they're some sort of sign of our national manhood or womanhood, right? We want a strong dollar because that means the US economy is strong. In reality, a strong dollar has benefits and costs, right? A strong dollar helps importers because it makes foreign goods cheap. But a strong dollar hurts exporters because it means other countries have to give up more of their currency to get dollars to buy US goods. So like most things in economics, there is nothing that is universally good or bad, right? And so, you know, don't fall into this trap of thinking, well, strong dollar is good and weak dollar is bad, or an appreciation of the dollar is good and a depreciation of the dollar is bad. No, it just is, right? A change in the value of the dollar creates winners and losers. So, you know, we don't say, as I have written here, there's a strong price for apples, right? We just say the price of apples has gone up or the price of apples has gone down. And that's a good thing for some people and a bad thing for other people. And that's kind of how you have to think about the exchange rate. So don't get caught up in thinking about exchange rates from this nationalistic kind of perspective. What determines exchange rates? Well, in our setup here, they're determined by supply and demand, the supply of dollars and the demand for dollars. And so I want to talk about four key determinants of exchange rates, right? Four key determinants of exchange rates in the long run, right? So in the long run, what do I mean is over the long period of time, right? Not so much day to day, but from week to week, month to month. What are some of the more important things that impact exchange rates? Four of them I want to talk about. Three in a little bit of detail, and one that we're going to have to talk about in more detail. The first, let's do the relatively short ones first. Differences in productivity between countries, right? Countries that are more productive tend to see their currency appreciate. Why? Because people want to take advantage of that higher productivity, right? So here's an example. Let's say the US is more productive than Europe and experiences faster economic growth, and US companies experience higher profits. Well, what's going to happen then? Foreign investors are going to want to invest more in the US, right? They're going to want to put their capital into the US and buy US stocks and US bonds. But to do that, they're going to have to buy US dollars. So if there's an increase in productivity in the US relative to Europe, we would expect the demand for dollars to go up and the dollar to appreciate, right? Remember, this is the dollar exchange rate. That's pretty self-explanatory, I think. So anytime productivity goes up in the US or growth goes up in the US, you can almost always expect that to put some upward pressure on the dollar because capital is going to flow into the US. Preferences play a role, right? If there's a preference for American goods, right, or American products, or branding or any of that kind of stuff, that's also going to increase the demand for dollars and put upward pressure on the US dollar. And then finally, tariffs and quotas. Tariffs and quotas are one of the important things that influence the value of currencies, and maybe not in ways that you would anticipate, right? So let's talk about this a little bit. Let's say that, well, this is not a hypothetical example, this is a real world example, right? We know that the Trump administration has placed tariffs on foreign goods. Why? They say that foreign countries don't compete fairly with the US, and as a result, until they play fair with us, we need to punish them by putting tariffs on their goods. How does that impact the US dollar, and then how does that impact the US economy? So let's think about this. A tariff on foreign goods means that foreign goods are more expensive and US goods become relatively cheaper. What should that do? That should increase the demand for dollars and should put upward pressure on the dollar, right? The dollar should appreciate, right? So starting a trade war with China should appreciate the dollar, right? Now, here's the more interesting question. Trump started this trade war in an effort to reduce the US trade deficit. What in fact has happened to the US trade deficit? It's actually gone up. Why? Because what happens when you start a trade war? The dollar should appreciate. When the dollar becomes more expensive, it discourages exports. So while a trade war discourages imports, the appreciation of the dollar discourages exports. And so the trade balance, which is the difference between exports and imports, doesn't change by very much, or it might actually go up. And that is exactly what we've seen here in the US, right? Is that the trade deficit that we have with China and other countries has actually gotten worse over the period of time that Trump has been in office, not better. This is perfectly predictable, right? Economists have tried to explain this to Trump for a long time, and he doesn't listen. But yeah, this is what happens, right? This is what happens. This is one of the costs of not really knowing economics. So one of the things that we as economists know is that starting a trade war is unlikely to impact the trade balance in a positive way. Now, it does discourage imports, but it also discourages exports. So it significantly reduces the amount or the volume of trade. It reduces exports and imports, but it's not going to change by very much the difference between the two. And it's certainly not going to change the difference between the two in a positive way, right? So anyway, this is just one of the kind of predictable policy mistakes that politicians often made when they fall asleep during their macroeconomics courses. So there's one other long-run determinant of exchange rates, and this one takes a little bit more time to talk, so let's take a break before we talk about it, and we'll be back with section 2 in a moment.